Hello, everyone. We'll just wait for a couple of more minutes because people are joining in. You can use the chat box to say hi to everyone and perhaps can tell from where you are joining. Hi, Javier. Hi, Ricardo. Hello, Rob. Okay, so we'll wait just one more minutes. Perfect. Okay, so I think let's start. More people will keep on joining. So, hello everyone. Welcome to the sixth edition of our Commodity in Focus webinar series. My name is Hemant Bansal. I head the Commodity Intelligence team at the Smart Cube. I've been with the Smart Cube for more than 12 years now, and basically I'll be your host for this webinar. From a agenda perspective, I've joined, with my team of commodity specialists who will first talk about a quick recap of macro outlook, what has happened in 2022 and how it is expected to shape up in 2023. Then each of our experts will basically deep dive into each of the commodity market outlook for the key commodity groups and commodities itself. Throughout the webinar, I would request you to post your questions using Q&A box and not the chat box, because then people can upvote certain questions and we can probably take it up on priority. So please do use Q&A box while putting your questions. So great. I think let's start. Let's jump right into it. And I would call Anuj to start with macroeconomic outlook, followed by a commodity outlook for metals and energy basket. Over to you, Anuj.
Thanks, Evan. So 2022 witnessed historically high inflation due to supply chain disruptions amid Russia-Ukraine war. Inflation reached 9 to 10% on annual basis in the Europe and the US and has been on the elevated levels. Europe experienced its worst drought in 500 years, which caused inflation by adversely impacting food production and river transport. This resulted in monetary tightening by major economies such as the US, Eurozone, and India. The US Federal Reserve increased the target range for federal fund rate from 0.25 to 4.5 in 2022. In similar lines, the European Central Bank and Indian Central Bank RBI have also increased their interest rates in 2022. central banks are committed to further increase interest rates to keep the inflation in control. Steep monetary tightening led to a 27% surge in US dollar index and a sharp fall in M3 money supply growth rate. However, the story was different for China as zero COVID policy impacted economic growth and kept the inflation at lower levels. Now, this significant monetary tightening across major economies has resulted in slowdown in economic activity, which can be seen by sharp fall in the leading economic indicators such as Purchasing Managers Index. Monetary tightening has also led to expectations of economic slowdown and risk of recession, which got reflected in Consumer Confidence Index declining to multi-year lows. The Consumer Confidence Index also dropped in China to historically low levels due to its zero COVID policy. To summarize, monetary tightening policies, rise in interest rate, and slowdown in economic activity is expected to have a lingering impact on 2023 outlook. In 2023, global economic growth is expected to slow down to 2.9% as compared with 3.4% in 2022. As per Bloomberg's Economist Survey, there is a 70% probability of recession in 2023. However, India is expected to grow the fastest among emerging markets in 2023 with a projected growth rate of 6.1%, a slight fall compared with the estimated growth rate of 6.8% in 2022. On 16th January, the People's Bank of China injected 935 billion yuan into the banking system to stimulate economic growth. Further, opening up of Chinese borders and ease in COVID-19 restrictions is likely to drive economic recovery in China. Now, coming to inflation, it is also expected to come down in 2023 from historically high levels, but it will remain above the target range of central banks. Central banks are expected to keep interest rates high unless inflation is below or within the desired range. Global economic activity is projected to slow down in 2023 due to the repercussions of Russia-Ukraine war, high inflation, and interest rate hikes by central banks. Downstream demand from the construction industry is expected to decline in Europe and the US due to high interest rates, while government stimulus in China is expected to increase the demand from the construction industry. However, demand from the automotive industry is projected to increase in 2023 due to anticipated ease in semiconductor bottlenecks and improvement in delivery times. High pent-up demand due to industries' underproduction in past several years is likely to support the demand. Now, let's deep dive into the metals basket to understand the 2023 outlook for both base and precious metals. Starting with base metals, the aluminium market will likely remain in surplus of 1.1 million tons, representing 1.6% of global production. The copper market deficit is likely to reduce to 760,000 tons in 2023 from a projected deficit of 798,000 tons in 2022. The zinc market deficit is also anticipated to decline 50% as rise in production from Brazil, Australia, Peru, and China will outpace the increase in global consumption. The nickel market is likely to be in surplus of 139,000 tons in 2023 as growth in production is likely to surpass the increase in demand. Overall, base metal prices are projected to fall in 2023, driven by the anticipated rise in supply and relatively lower growth in demand due to economic slowdown. However, historically low inventories, anticipated depreciation of US dollar due to projected increase in ease in interest rate hikes will likely be the key upside factors for the base metals price forecast. Specifically for copper, ongoing violent protests in Peru, one of the major producers of copper, and a likely rebound in demand from China is expected to limit the price fall. Now, coming to precious metals, gold prices are expected to increase due to anticipated pickup in demand for safe asset class with decline in US dollar and economic slowdown. Platinum prices are also forecast to increase in 2023 as the platinum market is likely to be in deficit of 304,000 ounces, representing 3.7% of global capacity in 2023 as compared with a projected 0.8 million ounces of surplus in 2022. Global platinum demand is anticipated to surge 19.5% on annual basis in 2023 on account of expected rebound in downstream automotive demand. Further, China's 6 BRDE standard emission regulation is expected to be implemented from July 2023, leading to higher demand for platinum. Moreover, industrial demand is estimated to jump 9.8% on annual basis in 2023, mainly due to a rise in demand from the glass industry. Now, coming to palladium, prices are forecast to decline in 2023 as market deficit is anticipated to decline to 0.2 million ounces, representing 2.9% of the global capacity in 2023 as compared with a likely deficit of 0.6 million ounces in 2022. Further, the global palladium supply is projected to increase 9% in 2023 as compared with an anticipated 10% decline in 2022 due to recovery in production in North America, Zimbabwe, and South Africa. Increased substitution of palladium with platinum is also expected to exert downward pressure on palladium prices. In 2023, 500,000 ounces of palladium demand may shift to platinum, representing 1.6% of palladium's annual consumption. Now, moving on to the energy basket, where we will cover crude oil and natural gas price outlook. Brent crude oil prices surged in the first half of 2022, driven by concerns regarding supply disruption amid Russia-Ukraine war. However, prices have fallen 34% from the peak of June 2022. In 2023, oil prices are forecast to fall on an annual basis amid slower demand and weak economic growth. Global oil demand is projected to grow 1.5% in 2023 as compared with an estimated rise of 2.2% in 2022. Record high inflation and aggressive monetary policy stance by major central banks are expected to slow down the economic growth. Oil prices are also expected to remain bearish due to projected rise in oil production in the US. Crude oil production in the US will likely increase 5.2% in 2023 versus 4.5% growth in 2022. Hence, OECD oil inventories are also expected to increase 2.2% in 2023 versus a drop of 5.6% in 2022. However, a potential further production cut by the OPEC plus countries may pose an upside risk to the price forecast. Now, moving on to the natural gas, gas prices surged in 2022 as Russia stopped the natural gas supply to Europe through Nord Stream 1 pipeline. Russia is the major producer of natural gas globally and accounted for 40% of Europe's natural gas supply before the start of Russia-Ukraine war. However, prices in both Europe and the US have declined more than 50% from their peak in August 2022. In 2023, natural gas prices are forecast to decline due to prevailing high inventory and low demand. As presented on your screens, high gas storage inventories in Europe amid warmer than anticipated winter 2023 and demand destruction is likely to exert downward pressure on prices. In the chart here, we are comparing the deviation of inventory for each month from 5-year average inventory, and it has a very high negative correlation of 89% with natural gas prices. Gas inventories in the US have seen recovery in Q4 2022 and are also expected to increase in 2023, leading to price fall. However, lower snow cover during 2023 winters and concerns regarding warmer summers and a sharp recovery in demand from China after the end of country's zero COVID policy are some of the upside risk factors to the forecast. Now, let's talk about the outlook for the petrochemical basket. Over to you, Neha.
Thank you, Anuj. So in the petrochemical basket, we will focus on 4 key chemical prices, that is benzene, ethylene, propylene, and caustic soda. Starting with a quick recap of 2022, which played out to be a very eventful year for the commodity market. The year started with a boom in petrochemical prices globally because of the macroeconomic disruptions and related energy crisis, which led to a sharp uptick in the raw material prices. However, the price corrected in the second half of 2022 due to speculation around the onset of recession in 2023, along with the contractionary monetary policies which were adopted by the major central banks across the globe. Well, this was the general petrochemical trend, but in exception to it, caustic soda prices played out differently in Europe. It continued to surge, reaching a quarterly 100% rise in the last quarter of 2022, majorly driven by persistent supply tightness amid fall in co-product chlorine demand and elevated electricity prices. And now quickly coming to 2023 price projections and market outlook. So overall in 2023, we expect global petrochemical market to witness a year-on-year decline, bringing prices closer to the pre-COVID levels. And the key factors that will drive this price movement will be raw material prices, demand, supply, and macroeconomic situations. And now starting with the feedstock price outlook, that is the key input to the cost of production. So we expect a lower upstream cost in 2023 as Brent crude oil and natural gas, which forms the constitutional chain for petrochemical complex, is foreseen to witness a yearly decline in 2023 as compared to the record high levels witnessed during the previous year. And moving on to the demand side, which is again one of the major factors impacting the market, is likely to slow down 2 to 3% in 2023 as compared to an estimated 5% year-on-year growth in 2022. This is majorly driven by the recessionary fear amid weak macroeconomic sentiments as the global GDP growth rate is projected to crawl in 2023. Along with this, The contraction in downstream resin market will have a negative impact on the petrochemical demand, which my colleague will discuss later in the later section. And now talking about the other side of the market, which is supply scenario. And as we can see in the bar chart here, we expect major capacity additions in ethylene and propylene in Asia, followed by the US. And referring to the announced capacity so far, we expect a total 24.5 million ton per year capacity addition in Asia, with ethylene and propylene contributing around 75% of the said capacity. Whereas in the US, we are expecting nearly 3 million ton per year capacity addition in ethylene, propylene, and caustic soda cumulatively. So to sum it up, the petrochemical prices are expected to correct from the elevated level as increase in supply will surpass the demand rise projections, along with the fall in upstream cost prices. And now let's dive into the market dynamics and price outlook for downstream resin basket. Over to you, Shruti.
Thanks, Neha. Now moving on to the outlook for resins. As you can see on your screens, we'll be focusing on three key resins: HDP, PP, and PET. As is very visible across all the charts, prices have witnessed a sharp rise till the first half of 2022. This was driven by strong demand from the downstream sectors, rise in feedstock, energy, as well as labor costs, railcar shortages in the US, along with plant outages and shipping delays. However, from the second half, prices started to witness a sharp drop, and the reason being slump in feedstock prices amid fall in crude oil prices, recessionary fears, and lockdowns in China due to growing COVID-19 cases. Many companies also adopted a cautious outlook for the second half of 2022 as consumers have less purchasing power due to inflation. Buying activity was also muted as buyers expected further price fall over the coming months. In addition to this, new capacity additions were witnessed majorly for HDP, which saw around 1.7 million tons of new plants, and PP, which saw around 4 million tons of new plants in second half of 2022. However, the drop in PET prices was relatively lower than that of HDP and PP on account of structurally short PET supply, especially in the US, amid surge in demand from the downstream bottle and packaging sectors. Then supply disruptions of feedstock PTA and acetic acid also added to the bullish sentiments. So this is what has happened till now. But the key question that comes to our mind is what 2023 will look like for the resins market. So we expect that on a yearly basis, prices across all the regions will witness a sharp drop compared to 2022 average price levels. As can be seen in the table below, drop in feedstock prices, be it propylene, ethylene, or paraxylene, driven by a fall in upstream crude and naphtha prices and ample supply across resins, will be one of the key factors to exert downward pressure on prices. Also, industry players across supply chain have shifted their behavior of buying and warehousing every single pound of resin to just purchasing or stocking the minimum volume while unloading expensive inventories accumulated when prices hiked. Further, capacity additions are also expected for all the three resins, which is 5 million tons for PE, 8 million tons for PP, and 4 million tons for PET. While on the other hand, growth in consumption will remain constrained as compared to the rise in production because of weak macroeconomic outlook. As per IMF, global growth is likely to slow down to 2.9% year over year in 2023 versus 3.4% year over year rise in 2022. In addition, inflationary pressure, as the US Fed indicated that they are likely to keep rates higher throughout 2023 with no reductions till 2024, will add to the bearishness in the market. So these collectively will result in this kind of drop in prices in 2023. However, the fall in price may be restricted because of certain factors. Easing of COVID-19 lockdown restrictions in China in 2023 being one of them. Then energy crisis in Europe, in case the Russia-Ukraine war escalates, may negatively impact the plant operations. And this may limit the domestic supply for resins. Okay, so that's all from the resins market outlook. And now let's talk about grains, vegetable oils, and dairy market with my colleague Kumar Amit. Over to you, Kumar.
Thank you, Shruti. So starting with grains first, prices of key grains such as wheat and corn reached a record high in second quarter of 2022. While much of this rally was driven by sharp supply and logistical issues because of the Russia-Ukraine war, some part of this rally, which started from mid-2020, was also driven by dry weather conditions in key grains producing regions such as Europe, US, and Canada. However, prices began to trend downward in June 2022 and lost majority of the gain registered in the first half of 2022. And the key factors contributing to this decline were, first, a record high output of corn in Brazil and further record high output of wheat in Australia and Russia. This was further supported by increased supply of grains from the Black Sea region post agreement to grain deal in July. The second factor contributing to this drop was demand rationing because of cost of living crisis due to a steady hike in interest rate by the global central banks and a slump in demand from the poultry feed industry, which witnessed a sharp outbreak of avian influenza across the US and Europe. Moving forward, we expect that grain prices have already reached its medium-term low and will likely rebound from here. The prices are likely to remain elevated till the onset of wheat harvest season in the Northern Hemisphere and corn harvest season in Brazil. In the next slide, we'll discuss why we expect prices to increase from the current levels. As you can clearly see, the two charts here highlights stocks to use ratio for both corn and wheat. Going by the stocks to use ratio, it clearly established that supply of these grains remains tight across the world. Starting on with wheat, stocks to use ratio in Europe is forecast to reach a record low in the current marketing year. Additionally, global ratio is forecast to reach a 15-year low during the year. While situation remains slightly better for corn, overall supply of the commodity will likely remain low. For corn, stocks to use ratio in Europe is expected to reach 3-year low in the current marketing year, and global ratio is forecast to remain marginally higher versus the 8-year low registered in the marketing year of 2020-21. Grain supply situation is expected to aggravate further as wheat and corn output in Argentina, one of the largest exporter of grains, is projected to drop by close to 44% for wheat and 5% for corn on an annual basis. And this drop will primarily be driven by ongoing severe drought in the country. Production disruption may prompt Argentine government to revise down export quota and might restrict corn exports, which will not be a good news for global grain supply in 2023. Now, another thing which will further contribute to supply tightness is a possible drop in wheat sowing area in Ukraine, where wheat sowing is expected to drop by close to 38% on an annual basis because of lack of funds and high fertilizer cost. These factors is also expected to contribute to a drop of about 32% on an annual basis in the country's corn acreage. Output in Russia and the UK for wheat is likely to drop by close to 19% and 6% on an annual basis in 2023. An estimated drop in grain output both in Ukraine and Russia, and likely escalations to the war in Ukraine as major NATO members such as Germany, US, and UK have pledged to provide battle tanks to Ukraine, raises serious concerns about the longevity of the competitive supply that has been coming out of the Black Sea region. Now, having discussed about grains, next we'll move to vegetable oils. And like grains basket, geopolitical and logistical issues, along with supply shortfall, pushed vegetable oil to its historic high in the second quarter of 2022. However, a surge in rapeseed output in Europe and Canada and a seasonal growth in palm oil output, in addition to increased supply of soybean oil from Argentina because of government's intervention, weighed on prices in the second half of 2022. Weak demand from China, lower than estimated biodiesel mandate by the Indonesian government, further contributed to this price drop, which also got support from the EU's legislation to ban companies using palm oil as feedstock in its product. For 2023, we expect vegetable oils prices to decline on an annual basis. In the next slide, we'll discuss why we expect prices to decline on an annual basis. Overall, vegetable oil supply are expected to increase in the current marketing year because of higher output in the key producing countries, which is primarily driven by high prices in 2022, which prompted farmers to increase acreage, and favorable weather conditions in key palm oil producing countries further improved supply of palm oil. In 2023, a record high output of soybean in Brazil, which is expected to rise by close to 19% on an annual basis, will likely offset the effect of lower production in the US and Argentina. To give you a context how Argentine production will likely evolve in 2023 is, by the week ended February 2nd, only 12% of the total soybean crop in the country was rated good to excellent, which is about 26% point lower versus the crop condition in the previous year. Nevertheless, continued geopolitical tension between Ukraine and Russia and uncertainty over grain deal poses a threat to sunflower oil supply that might restrict any significant price drop in vegetable oil prices in the first half of 2023. On demand side, while fear of economic slowdown might affect demand from the food and beverages industry, consumption from the biofuels industry is expected to remain high. And the reason why we expect biodiesel consumption to increase are the Indonesian government has already implemented its B35 biodiesel mandate, which is about 5 percentage point higher versus the current mandate of B30. And this is aimed at reducing the country's dependence on crude oil and boost domestic palm oil consumption. This increase in blend will likely translate into an additional palm oil consumption of close to 2 million tons in 2023. Apart from Indonesia, Brazil is also expected to increase biodiesel mandate to 15%, which will also be about 5 percentage point higher than the current level. And this higher mandate will be implemented from 1st of April. Also, demand from China is expected to pick up because of low vegetable oils stocks in the country and rapid reopening of borders and other services by the government. To summarize, while we expect prices to slump on an annual basis, it might trend upward versus the level seen in January, as Brazil's summer rain have delayed soybean harvest in the country and have supported growth in the incidence of soya rust, which has further prompted farmers to increase pesticide application, thereby pushing up total fungicide cost by close to about 10%. While this might push up harvest cost, high rust on crops may lead to lower than expected growth in the country's soybean yields, which, in addition to a likely drop in Argentine soybean crop, might keep supply tight during the period. After talking about grains and vegetable oil markets, let's take a look at important sector, which is dairy, considered to be the cheapest source of protein though a consistent uptrend in prices over fourth quarter of 2021 and third quarter of 2022 has made it no longer a cheaper alternative. Starting out with overall trend in 2022, the year began with an uptrend in prices on account of weak global supply, which was driven by production drop in Europe and the US, and production fell because of shrinking farm margins due to high feed cost, which also motivated farmers to shift to beef farming in expectation of better return. To give some context on the shift, dairy herd count in Europe fell by about 1% on an annual basis in 2022. The war between Russia and Ukraine worsened the problems with the supply chain and drove up feed and energy prices dramatically. The farmers' strike in Netherlands, France, and Germany, and the worst EU drought in history further decreased supply of green pastures, contributing to the upward trend in prices. Prices continue to rise due to high safety stock buildup and China's demand for dairy products between second half of 2021 and the second quarter of 2022. In addition, the Russia-Ukraine war also pushed up panic buying, leading to uptrend in prices. Moving into quarter 4 of 2022, prices began to trend downward as a result of the EU's milk output exceeding expectations and the unseasonably mild weather that contributed to this higher output of milk. During September till November, milk production in Europe reached about 34.4 million tons, which is about 2% higher versus the average 5-year production over the last 5 years. For 2023, we expect dairy prices in Europe to drop on account of steady supply outlook and likely weakness in demand. On supply side, expected favorable weather will support the growth of feed and pastures, leading to stable growth in milk production and will further increase fat and protein content. As per European Commission, fat and protein content in milk is expected to rise by about close to 0.5% on an annual basis in 2023. Increased farm gate milk pricing and genetic enhancement in the herd will also help increase milk output this year. On demand side, a significant decline in demand from the Middle East because of a drop in purchasing power brought on by low oil prices, and China because of excessive supplies in the country is projected to support the downtrend in pricing, at least in the first half of 2023. Further, dairy prices in Europe are not competitive, which will further restrain demand from overseas market. As of mid-January, S&P prices in Europe were about close to 8% and 5% higher compared with the prices in the US and the APEC region. Also, due to high price levels, purchasing interest from price-sensitive markets with low GDP per capita, such as Southeast Asia and Africa, may also decrease. Retail demand, particularly for premium dairy products, is projected to decline due to high inflation, tight monetary policies, and impending recession. Now, those were the market fundamentals pointing towards a drop in food prices. However, one could argue that even in the event of economic slowdown, why would food prices go down given the commodity we have talked about mostly falls under staple food category? To address this question, we have taken a closer look at the impact of economic situation on food price movement. As evident from the chart, we have compared movement in the European GDP with the food price index and milk prices. The chart clearly highlights the positive relation of the food price index with the EU's GDP growth. Refer to the arrows showing similar movement in the respective data points. A slowdown in economic growth affects demand and prices of food products, including dairy, negatively, as evident from the movement during the global economic recession of 2008-9. Hence, to sum it up, we expect that a likely slowdown in the world's economic growth in 2023 due to geopolitical situations and interest rate hike by global central banks may exert a downward pressure on demand and prices of dairy and agro commodities in 2023. Having discussed about grains, vegetable oils, and dairy, Anuj will now go through some other crucial factors that could impact commodities across all baskets. Over to you, Anuj.
Thanks, Kumar. Now let's take a closer look on a very important analysis, that is the impact of rising interest rates on commodity markets, which we have baked in our projection. Historically, higher interest rates have led to a decline in commodity prices. In the chart, we are comparing the trend of year-on-year change in commodity price indices and 2-year bond yields at 1-year lag. This is very important to note that we are taking 1-year lag in our analysis, and we will shortly share the significance of it. We can see during 1978 to 1982, 1987 to 1990, 1994 to 1995, and other time horizons that the rise in bond yields has resulted in fall in commodity indices. As we all know, higher interest rates increase the cost of carrying inventory and also lead to economic slowdown, leading to lower demand for commodities. However, it is interesting to see that 2-year bond yields at 1-year lag tend to have a very high negative correlation in the range of 70% with commodity prices. Statistically speaking, 1% hike in bond yields lead to 9% fall in commodity prices. Therefore, to conclude, and this is very important because what it means for us is that the recent rise in interest rates during 2022 is expected to lead to a decline in commodity prices in 2023. And if we combine it with the commodity fundamentals, the fall could be a significant one. Over to you, Hemant.
Thanks, Anuj. Thanks everyone for giving us a very insightful outlook for each of the commodity groups along with the commodities. Now, before we move on to Q&A, I think I'll take a couple of minutes, to update you on some of the additional resources for more information on key commodities. If you would like to learn more about the commodities outlook for 2023, please visit our website and check out our recent commodity mega trends for 2023. Through our interactive, interface, you can easily shortlist the commodities, view the price movement, and understand the key drivers. Also, to watch out for our quarterly commodity wraps, a new ease-in style quarterly series, that will help you understand the macroeconomic scenario and commodities price trend across key commodity groups on a recurring basis. So the first edition is actually is coming out in March this year. Lastly, please do take a few seconds to complete our survey link. We have shared this link in the chat box. It would really help us, in improving our commodities in focus webinar series. Great. Okay, so now let's take a quick look at the questions. So the first question we have received here is, just give me a second. This is Anuj for you. Natural gas prices are expected to plunge, but the graph looks pretty flat from January onwards. What's your interpretation?
Yes, so natural gas prices are expected to, plunge on an annual basis, compared to the 2023 levels. However, the prices in the US seem to have bottomed out as they are currently, almost at the cost of production levels. And in the Europe as well, going forward, there will be some of the risk factors, which can increase the prices on a monthly basis.
Perfect. Okay. I think the next one is also for you, Anuj. Is India's 6.1% growth factoring in expected COVID impacts to its economy in 2023?
Yes. So it does take into impact of different events that can occur, and this is basically the consensus forecast for Indian GDP.
Okay. Moving on to the next one. How will petrochemical prices react to the EU CBAM carbon tax announcement, which are to be implemented in October 2023? I think this is for you, Neha.
Yes. So in the initial stage of the EU CBAM proposed carbon tax mandate, petrochemicals are not included. So at least in 2023, this will not have a direct significant impact on the petrochemical prices in general. However, chemicals like ammonia will be impacted as fertilizer is included in the said carbon tax mandate.
Okay. The next one, given that EU imports PET, how are the European producers dealing with cheap imports in the current market? Shruti, would you like to take this one?
Yes, Hemant. So the imports of PET from Asia are available mostly at attractive prices on account of the fact that Asia has not seen the same price escalation that NA and EU have seen. As a result of which, the European PET producers are being pressurized to lower their offers to close the price gap with imports. And most domestic suppliers are also operating at low rates to prevent inventory buildup. So unfortunately for the PET industry, the outlook for demand and margins in Europe remains depressed, and availability is also not an issue in the European market as yet.
Okay, we have one more question from Krishna Murthy. The question is, how does refinery shutdowns in US impact paraxylene prices going forward? We are seeing higher gasoline prices in spite of crude oil prices stabilizing. Neha? Neha, could you?
Yes.
Yeah, how does refinery shutdowns in US impact paraxylene prices going forward?
Yes, so they're gonna move in the same trend as the other petrochemical prices. So we are expecting, despite the refinery shutdown in the US, we are still expecting the prices to go down because of the addition in the capacity in the US.
Okay, so addition of capacity is expected to offset the current refinery shutdowns, is it?
Yes, yes, Hemant, correct.
Okay, very timely and the latest question on the topic, Anuj, I think it's for you. What's the impact of the Turkey earthquake on Brent crude oil?
Yeah, so the oil exports were halted from the Ceyhan terminal on Turkey's coast after the Monday's earthquake. And Ceyhan is basically a major hub for Azerbaijan oil exports. It handles almost 600,000 barrels per day of Azerbaijan oil exports, and it handles 350,000 barrels a day exports from Iraq. So, in the short term, we anticipate that, the Brent crude oil prices will basically, will see some upside move because of this.
Okay. The next question is on corn and wheat, Kumar. So question is, are there any possibilities that farmers in the US may reduce corn and spring wheat sowing in 2023?
Yes, basically, the current situation points towards very low soil moisture in US, and if soil moisture does not improve before the spring sowing season, farmers may want to skip some of the acreage dedicated for corn and spring wheat and may choose to plant winter wheat later on the year.
Okay. The next question is, what about the price of concrete and steel? Anuj?
Yes, so the steel prices, have sort of bottomed out and have started to increase, from mid of December and from January onward, right? With China's ease in COVID-19 restrictions, we are anticipating that the demand will be high in first half of 2023, and with Asian Games schedule in Q3 of 2023 in China, there will be sort of some production cuts that may happen. Therefore, we anticipate a robust demand from China from first half of 2023, and for US as well as for Europe, we anticipate a slowdown in the construction activities, which will have a sort of downward pressure on the prices.
Okay, I think one more similar question related to metals market. Any insights on stainless steel and titanium markets? So I think we have covered steel. Any insights on titanium markets, Anuj?
Yes, so titanium ingot, prices have been very high after the Russia-Ukraine war, and with the increase in demand from the aerospace industry as well, it has been quite high, and stable for the last quarter. However, in 2023, we anticipate some increase in supply of its feedstock, titanium sponge, and some decline in demand from the downstream consumers, as the major consumers from the aerospace industry are now have basically reduced their restocking activity and purchasing material as per their demand schedule, which will have a sort of negative pressure on titanium ingot prices in 2023.
Great. Okay, so the next question is on sugar market. Rahul is asking this question. The sugar supply market has tightened. However, there are still the reflections on the future price projections are not commensurate. Why?
So basically, we have not covered sugar here. And to answer this question is because the sugar supply has tightened because there was some delay in sugar harvest in Vietnam and Thailand, basically, and also the recent rainfalls in Brazil has affected overall supply situation and indicating a slight lower than expected growth in yields. But we still think that increased sugar output in India because the may prompt government to reverse the restrictions that they had implemented in earlier this year. Sorry, later half in early Q4 2022.
Okay. Okay, so the next question is probably I can take. The question is, how do you rate the commodities mega trend stable? I think this is related to that infographic. So I think the process is you go to our website, there is a quick form asking you for your basic details, and then you can click submit. It will open up a dashboard. So if there is a provision to select a filter, so you can click if you want to see agro commodities, so it will filter out the agro commodities, and if you hover on the circles there, which is circles are basically pointed to supply, demand, and price projections. If you hover onto that, so the entire content will get displayed. Okay, one more question, I think, Anuj, what is your Russia-Ukraine war assumption, for your forecast? Is it escalation, de-escalation, or status quo, or yeah?
Yeah, so we have considered status quo for our price forecast.
Okay, so is it, Anuj, just out of curiosity, so it's status quo, basically we are saying that it will still linger on for at least couple of months, and that's what we have baked in our forecast?
Yes, yes.
Okay, so the next question is, how will China's reopening affect the Brent prices in 2023? And one more similar question, why won't oil plunge to $40 per barrel in line with the recent natural gas price fall? So these two questions basically.
Sure. So let me first take up the question regarding Brent crude oil. Um, so the demand for crude oil, is expected to increase specifically from the US as its strategic petroleum reserve, have fallen to a record low levels, and it will basically try to, refill those stocks, as well as further the US stocks, crude oil stocks are at 5-year low as seen on and they are basically at around 800 million barrel, compared with the peak of 1.2 billion barrel during 2020. Additionally, with the reopening of Chinese economy, we do anticipate demand for crude oil to increase from China. Additionally, we have seen historically that OPEC Plus try to control the prices, by reducing their production. Further, the Russia oil production is expected to, decline eventually in Q1 2023 and throughout the coming years because of the sanctions applied by the G7 and Europe and other countries.
Okay. Next one is on the wood market, though we have not covered it in this webinar, but Kumar, perhaps you would like to answer how the situation in 2023 on the wood market.
So basically, if we only look from a hardwood perspective, overall, since we expect that there might be an economic slowdown and overall global central bank continues to maintain its hawkish monetary stance, so the growth in construction sector will remain affected, which might impact demand for wood from the construction industry and hence exerting some downward pressure on prices of wood.
Okay. Next one is on industrial gases. So any information about industrial gases such as argon, helium, nitrogen? Anuj?
We currently are not covering these gases, and we can probably come back with the email based answer.
Perfect. Okay. Any insights into silicon supply challenges in 2023?
So silicon metal, is basically so it is impacted by the the electricity or the power rationing that generally happens in China, as China is a major producer of silicon metal globally, and basically it's the global leader in terms of pricing. And we have seen historically that whenever there are sudden power rationing in China, that impacts the silicon metal production, and we do anticipate these production cuts and China's goal towards carbon neutrality over the years expected to lead to certain decrease in production for the silicon metal.
Great. Great. I think we are just on time and there are like a couple of more questions. Perhaps we'll try to answer them, offline. But I think just one last question for you, Anuj. You said automotive industry will recover. What about gas impact?
Are you referring to gasoline?
It's not written here. It's not clear from the question, but yes, we can answer from a gasoline perspective, please.
Yeah, so gasoline demand, is expected to sort of increase, with the increase in the automotive sales. However, the prices, will be determined majorly driven by the refinery operations as well as the crude oil prices.
Great. So I think that's it from our side, folks. Thank you for joining in. I would again request you to please fill the feedback survey form, which was, the link was shared in the chat box. Thank you. Thank you, everyone.